So as most of you have figured out by now, I'm an extremely huge Alibaba bull. And just to give you a quick refresher on what my price target is for Alibaba, due to the entire deterioration of the share price and the weakness surrounding the entire Chinese equities market, surrounding the crackdown, surrounding the NIPO, now even the Evergrande Group is causing such a huge commotion in all the different Chinese investors particularly. So that said, my long-term price target for Alibaba still remain relatively stable. I'm looking at a 4-digit Alibaba price tag by 2030, which is in around 8 years time. And judging from the current price point of around $160 to $1,000, you go and calculate what is your cumulative return. And for some of you who have been constantly following me, some of you might feel that I'm extremely optimistic, some of you might even feel that I'm pessimistic. So despite being such a huge Alibaba bull, I would like to say that, hey, there's someone even more optimistic than me. And for some of you who have been long-time subscribers and loyal followers of this entire channel, I believe some of you have actually also come across a fellow YouTuber named Andrew. And he is even more bullish than me. He thinks that Alibaba has a 10x opportunity from here. So I'm extremely excited to have this collaboration opportunity with him, even though it might not be a face-to-face interview because we do have a 12-hour time difference. But for this collaboration, we are going to stitch our video together and you can hear him out on why he thinks Alibaba has a 10x opportunity from here. So with that in mind, you can be equally optimistic as him or you can agree to disagree. And I also believe that for those of you who have been loyal subscribers of this entire channel, you should know my valuation, you should know my outlook, you should know my bull thesis of Alibaba. If you haven't done so already, are you sure you're even a subscriber of this channel? With that in mind, let's hear what Andrew has to say.
Hey guys, glad to be here. So as far as my valuation framework goes for Alibaba, it's actually quite simple. Let me quickly begin by saying that my favorite investor of all time is Peter Lynch, and the reason is that he made understanding investing super simple for me. Sure, we have other legends like Munger and Buffett, and they're of course great educators, but nothing broke things down quite like Peter Lynch. So one thing Peter Lynch is known for is his infamous PEG, or price to earnings to growth ratio. Now, I'm sure we're all aware of what this formula is, and if not, then go look it up, it's literally everywhere. But the idea is that Lynch always said that if you can buy a business at a multiple equal to its growth rate, then you'll probably earn returns similar to that growth rate. So, for example, if a business grows at 15% per year and you purchase it at a multiple of 15 times earnings, then you'll earn roughly 15% per year. Now on the flip side, if it grows at 25% per year and you buy it at a price to earnings ratio of 25, then you'll probably earn about 25% per year on your investment. Now, I have to admit, there's something big he's missing here, and I'll be explaining it in just a bit. But for now, the main thing I want you to remember is that if you buy a business for the same multiple as its growth rate, then you'll probably achieve returns equal to that growth rate. Now, here's where things start to get interesting. You see, historically, what I found is that businesses actually typically trade closer to 1.5 to 2 times their growth rate, which means for a business growing at about 20% per year, it'll actually typically trade closer to a multiple of about 30 to 40 times earnings. So this brings me to Alibaba. Alibaba has historically grown earnings at roughly 30% per year, and I can honestly see this continuing moving forward. However, on the flip side, since Alibaba is a very large business and is also a Chinese equity, the risks are obviously viewed as being greater than, equities and companies here in the US. Now, that's okay because I'll just use conservative estimates and say that Alibaba will only grow at 18% per year moving forward. So once again, they've been growing at 30% per year, but we're just going to say that growth slows all the way down to 18% per year moving forward, which is what I'd argue is probably a realistic bear case assumption. The next is that a large argument, of course, is that since there's more risks in China, Alibaba deserves a far lower multiple than its Western counterparts. To that, I'd say, okay, fair enough. So instead of using a price to earnings to growth of 1.5 to 2 times, let's just assume a price to earnings to growth of 1 times, which would put Alibaba at a future price to earnings ratio of about 18 times. Ironically, Alibaba is currently trading right around a price to earnings ratio of about 18 times, which means that if they grow at 18% per year and continue to trade at 18 times earnings, then we'd achieve 18% returns per year. Now, I don't know about you, but those sound like some pretty damn good returns. However, on the flip side, let's make more of a bullish assumption and assume that Alibaba achieves about 25% growth per year moving forward. And let's also assume that in about 5 years, the tension in China has faded and investors are once again bullish on the outlook for Chinese businesses. In this scenario, we could realistically expect a price to earnings to growth ratio to normalize back to about 1.5 times, or in this case, if they grow at 25% per year, the future multiple could be roughly around 38 times earnings. If you don't think that this is realistic, look at companies right now and see where they're trading at. If this in fact happens, then we could see returns of roughly 6 times our investment in just 5 years, putting Alibaba at a 2026 price per share of around $1,000. So once again, in our bearish assumption, we collect about 18% per year moving forward, or more than a double on our investment in just 5 years. However, on the upside, we could collect about 6 times on our investment in just 5 years. Now, if we just think about that and compare that to other investment opportunities out there, that might sound pretty intriguing. But anyways, guys, that's how I'm deciding to value Alibaba. Once again, I appreciate being a guest on the channel, and as usual, thanks for watching. Peace, guys.